Gautam Duggad, who is head of research at Motilal Oswal Securities, joins in with his perspective on the markets. Gautam, it's great to have you on the show. Good morning. Thanks very much for taking out the time. How do you map the trend on earnings now? I'm sure that even in your debates and discussions with peers, there's all that talk about the year starting off on a very high note in terms of earnings expectations, and then the reality dwindling the numbers down to single digits. Is there going to be a similar scene in FY19, or you think there is evidence to show that this time around the recovery would be for real?
Hi, good morning. So I think as the earnings season is ended, one can now also take a step back and look at how the entire FY18 has panned out. And I think we've ended Nifty with a 9% EPS growth in FY18, which I think, while not great, is far better than what we have been getting in the last 2 to 3 years. Specifically for the fourth quarter, if you basically look at the aggregate numbers, they tend to get vitiated by what happened in PSU banks. So for the quarter, at least you'll have to look at aggregates excluding PSU banks and some of the private corporate banks. So when I look at my universe of 220 odd companies, excluding these 9 companies, we are looking at we've got an earnings growth of around 17% versus expectation of 15. Even for Nifty, for the 47 companies, excluding the PSU bank and the 2 private corporate banks, you got almost a 15.5% kind of an earnings growth. Now, second thing, if you just look into the details of the estimates for the quarter, we've not downgraded our estimates for FY19 and 20 for this quarter, and this has happened after a long time. So clearly things as we exit FY18 are far better than when we entered FY18. One can obviously, from a cynical viewpoint, if one were to say that you started the year at 17%, you ended at 9%, but look at the internals of the earnings progression this year. The extent of downgrades was far lower. The absolute quantum of growth that we got on a full year basis for FY18 for Nifty was far higher than what you got in FY15, 16, and 17 put together. Looking at FY19, clearly things are going to look far better than what we have seen in FY18. Obviously, the low base of last many years is there. Secondly, some of this heavier set of banks on the corporate banking side, they're obviously going to benefit because of the low base, and as things progress on NCLT cases, you will see provisioning requirement coming off. So for us, while the overall Nifty earnings growth is estimated at 27%, but I will look at Nifty growth again excluding these 3 corporate banks and the PSU bank. Then for us, the earnings growth is at around 19%, which is, I would think, far healthier, even if one were to exclude the pop from the low base of some of these banks. So 18-19% earnings growth for the 47 companies put together for Nifty is an uptick compared to the last 3 years. For example, if you were to look at like-to-like numbers for Nifty also, again excluding these 3 banks for FY15, 16, 17 and 18, you got earnings growth of around 9 to 10%. And obviously this has also been helped by some of the smart companies coming into the index, which has far better earnings stability than the ones which exited from the Nifty. So earnings picture A looks far better for FY19 compared to FY18. And obviously some of the sectors which are helping are sectors belonging to the consumption pack, sectors belonging to the private financials pack. The earnings growth is going to be very narrow again. I mean, if I were to take a deep dive in my own FY19 estimates for earnings growth for Nifty, barring 5 Nifty companies, rest of the 45 companies put together are growing only at 14%. So that also puts to risk the earnings growth estimates again. I mean, SBI, Tata Motors, ONGC, ICICI and Axis, these 5 companies together comprise almost 55% of my incremental earnings for FY19.
Right.
So while it is providing a pop on a low base, it is also providing a risk.
It is indeed. Gautam, just intrigued by the way some of the pharmaceutical names have moved last week, and now after the VIs for 2 important facilities, one for Sun Pharma, the other for Oro, you are seeing a huge leg up play out in the sector and sentimental rub off on the entire segment and not just the newsmakers. Would you say now is the time selectively to start nibbling into pharma or go, whole hog?
No, I think that time is still far away. See, what has happened is this sector has been massively beaten down in the last 2 years. You have seen an earnings downgrade of almost 40-50% for the top 5 pharma companies over the last 5-6 quarters. So valuations, while one can say that they're beaten down, but if you juxtapose that with the earnings downgrades that have happened, I don't think the sector has seen a big derating so far. What has just happened is stock price have followed the earnings downgrade, at least for the top 5 pharma names which are there. Secondly, any incremental bit of good news is clearly having a disproportionate impact on stock price, and which is fair because you've seen 50-60% correction in stock prices over the last 2 years. So it is I would reckon there can be some trading opportunity here and there, but fundamentally if you still see the US pricing pressure is still there, you are still not seeing any up move from that part of the equation. So companies selectively, because pharma is not a universal sector, each company is to its own. So wherever you see opportunities on the complex generic side, especially on the US side of the market, and companies which have a very high domestic focus, they will tend to outperform. But from a sectoral perspective, I don't think that we are still out of the woods yet.
What will give you the signs that we are seeing green shoots of recovery and stepping out of the woods?
See, I think a couple of things need to happen there. You need to get a sense of continued strong earnings growth on a sustainable basis for a couple of quarters. So far that has not happened. Obviously last 5-6 quarters you have seen a double-digit downgrade in earnings, or double-digit decline in earnings, at least for our universe. So probably at some point of time that base effect will come into play. But underlying things need to recover, the approvals need to improve, the launches need to improve, the overall the pricing decline pressure which is coming from the US side of the market needs to subside before one can conclusively say that the worst is totally behind for them. Obviously the stock price may not fall now on incremental bad news, because you've already seen a lot of decimation in some of these large names in the pharma sector. But from an earnings point of view, things are still not looking great. Even this quarter, one of the sectors which has seen the maximum downgrade in earnings was pharma. We've seen around 9% downgrade for our universe put together for FY19 earnings for pharma sector.
Right, and so do you think that sectors like pharma and IT have seen their worst days behind? I know with IT a stronger case is building on that front, but with pharma, everybody says it's very company specific. Though when you look at the price action, there is still a high correlation technically, which is why these stocks move as a herd.
No, so what the one fundamental difference between pharma and IT has been, IT is a far more universal sector. Any trend on the client spend, it percolates down to all the IT companies, which is not the case with pharma. And secondly, in IT, we have seen the sizes of digital businesses going up. Digital business as a percentage of sales is far more, relevant today than it was, say, 5-6 quarters back. That is actually not the case with pharma. Pharma becomes a very stock-specific approach, very news flow-driven. What happens on a particular day, depending on what US FDA or other regulatory body does, has far more influence on the stock prices in pharma sector than, say, in IT sector. So if one has a lower risk appetite, obviously IT today is looking far better, given that currency is in their favor. The commentaries across the board, whether it is large cap or mid cap in IT companies, has improved substantially, and you're seeing global growth picking up. So those factors, make the case for IT far more stronger than pharma. Pharma one can be contra, but again, when you're doing contra investing, you're not sure what is coming your way. So news flow, at least at the moment, we have seen some, the bad news flow has subsided for the moment. But again, it is a very company-specific approach that one needs to adopt in that particular sector.
Okay, Gautam, great to get in your views. Thanks so much for taking the time out and joining in today.